morning, everyone. My name is Monique Charland, and I'm the CEO as well as the founder of the franchisor company Business Accounting Network, or better known as BAN. And I'd like to extend a very warm welcome to all of those joining our monthly business webinars for the first time, and a very warm welcome to our clients. In our capacity as accountants and tax practitioners, also often we see business owners who either don't communicate with their accountant when they do something that knowingly or even unknowingly will directly affect an aspect of their accountant's responsibility. And that leads to accounting, tax, and increased cost consequences, as the cost of rectification greatly exceeds the cost of doing things right the first time. Or business owners who make decisions without asking their accountant or consulting with their accountant first before doing so. And that results in equivalent consequences, as well as some poor business decisions. So our presenter today is Cobus Visser, who will be sharing some ideas on focusing on avoiding costly business mistakes and asking your accountant first. But Cobus is a BAN franchise owner, and he's based in the Western Cape. He qualified as a professional accountant in 2010 after completing his psycho articles, and went on to obtain his diploma in advanced accounting science, which is his CTA level 1, in 2011. He's a registered accountant and tax practitioner with AGA, which is an association designation of the South African Institute of Chartered Accountants. So just a little housekeeping before we get started. Cobus might stop after maybe the first 3 or 4 topics, because we are going to be covering quite a broad spectrum of issues that us accountants see that business owners should be asking their accountants. But we would love to hear from you. So if you have any questions during the presentation, please type them into the chat box. Shane has already shown you that on your panel screen to your right. And now, without any further ado, let me cross over to our presenter this morning, Cobus Visser. Good morning, Cobus.
Morning, Monique. Thank you for that introduction, and good morning to everyone attending, to all our listeners. A very warm welcome, and thank you for taking the time. So I'm going to jump straight off my cam. You don't have to see me, and then we can fire ahead. Okay, so I think, how many times have you heard your accountant say, you should have consulted me first? All too often business owners make decisions without knowing or realizing what the tax, accounting, or even operational implications might be to the business or to themselves as personal taxpayers. Using your accountant partially and not to their full potential because you think you are saving costs incurs greater costs later on. As accountants and business owners ourselves, we have identified several questions that business owners should be asking their accountant before just doing it, so to avoid the costly mistakes that we see frequently. Accountants are skilled professionals with the necessary knowledge and expertise when it comes to accounting, tax, and even business-related matters. And business owners should make use of this. I believe your accountant should be seen as a business partner to assist in the decision-making process and helping the business grow. Business owners are not expected to know everything when it comes to accounting and tax-related matters, and that's why you have an accountant to consult to assist with these matters. As Monique mentioned, communication is so important between business owners and their accountants, and this goes both ways. But your accountant won't be able to help you if you do not inform them or provide them with the necessary or relevant information. Rather spend some time and consult with your accountant to avoid these costly mistakes going forward. And if you're unsure, ask your accountant rather than consulting Dr. Google. As accountants have those expertise and knowledge. So we're just going to go into some examples in this presentation. We might not go into much detail, but let's start off with, I'm just going to give a quick overview of what we're going to have a look at today. And then I am going to ask you some questions a bit later on. So first off, we're going to do choosing the appropriate accounting software package, registering a new entity, shareholders, changes in directors, updating the tax representatives and public officers, applying for finance, changing of banking details, fixed asset registers, record keeping of transactions, supporting documents and petty cash, VAT and VAT verifications, SARS e-filing profiles, the directors or owners as personal expenses, declaring of dividends, appointing finance staff, payroll and employees, and where more than one accountant is involved. So starting off with choosing the correct accounting software. And you're going to hear these words a lot today, very important, and ask your accountant, because this is very important. Just starting off with accounting software, you need to choose a software package that will suit your bookkeeping and operational needs. You know, what works for the one might not work for the other. We have found in the last, especially in the last year or so since lockdown, that your cloud-based accounting packages are very popular, like your Sage Business or your Xero, and they are very user-friendly and quite very nice. It's nice packages to have, but it's important to discuss with your accountant before just deciding on getting an accounting package, because that might necessarily not work for your business. For instance, if you look at desktop accounting packages like your Pastel Partner or Evolution or Express, those packages are much better suited for entities with high volumes of stock, like for instance manufacturing entities, and those stock modules are integrated on your Pastel Partners or Evolution, where it's not really integrated on Xero and say for instance Sage. They do have item modules, what you can call, but it's not really that good when compared to Pastel. So that's why it's very important to sit with your accountant to make sure that this is the correct accounting package that you're using. And just to note that I see a lot of free packages that we can get these days, especially cloud-based. If it's free, it's probably not that good. So rather, spend a bit of money and getting the correct package, and that will save you costs down the line. Obviously, you need to make sure that it's user-friendly and that you and your staff will be able to work on it to get the necessary training. And this is where your accountant can also be very helpful to give you that training, because they normally know how these packages work. Also to note that it's a legislative requirement that you should be able to produce printable reports on your software package. So the Companies Act requires for some reports to be kept for 15 years. And that's just not your invoices or bank statements or supply invoices. That's your transaction history, for instance, your ledgers on your packages. So that you need to be able to produce those reports and keep them for 15 years. So you can imagine if you're using a package that's outdated, or your license fees weren't paid, or it's not up to date, and you might not be able to access those reports anymore if it wasn't printed before. If you just kept it online or kept it on backups, you might not even be able to restore that backup, and then there's going to be great consequences in that. So also remember, you should always make backups, and you should be able to restore it. And again, your accountant should have access to your package. So make sure that you're using the same. If there's an outdated version, the accountant might not be able to restore that version on his or hers, or in his Pastel or partner, that whatever they use. Obviously with Sage and your Xero, your cloud-based, that's not an issue, but you still need to make sure that the reports that you have are printable and you keep record of it. So moving on to the next part is registering a new entity. And this is also again where you should perhaps ask your accountant to assist, and do not just register an entity on CIPC. We've seen that in the past and anybody can create a profile in CIPC and they can go ahead and register, follow the guidelines, and just register an entity on CIPC. But again, there is a lot of technical matters that you need to take into consideration. For instance, the shareholders, the issue of share certificates, the issue of and authorization of shares, your share capital, the memorandum of incorporation. A lot of people just use the standard MOI or Memorandum of Incorporation that SIPC gives, but that's not necessarily it's going to work for your entity or be of relevance to your entity. So that's why it's important to ask your accountant to assist with that, and also what the reason is for wanting to register an entity. Is this your first entity, or is it perhaps an additional one that you're registering? If it's your first one, perhaps you need to look at the tax structure, perhaps, and the costs involved. It's when you operating or registering and running an entity or a company is very onerous and it can be very expensive. If you look at, for instance, your statutory fees, your SIPC annual fees, and that you need to pay once a year, even financial statements for companies or CCs, if there might be additional cost, independent reviews that we're going to touch on a bit later on. So you need to make sure that you take all of those into consideration, and maybe it's advantageous to perhaps trade in your own personal capacity for the start as a sole proprietor. Also very important, you need to be informed of the responsibilities of directors. As mentioned, this is very onerous, and you need to make sure that you are aware of what those responsibilities are before just opening a company and registering it. As mentioned, the tax structures does play a role, which you need to have a look at. For instance, if your entity this is now not your first entity, your entity at the moment qualifies for small business corporation tax. Small business corporation tax is basically for small businesses. There are a few requirements, but basically you pay a tax according to tax scales as per SARS and not a straight 28%. So that is something that you can consider when registering an additional entity, if that might have an influence. If you're one of the requirements is if you cannot be a member or a owner of another entity, then you will lose that SBC status, that small business corporation status. So that's something to take into consideration. But there's also advantages of registering additional, let's call it additional or separate entities, for instance, for restructuring purposes. If we're looking at an example, if you or your company, you're a manufacturing concern and you have an investment property, and at the moment that investment property or the building is in the same entity that you're running the trade or the business from. So that's not a bad idea to register that property in a different company, so that the investment property is separate from your business or trade, to protect that investment. So if something goes wrong down the line and you need to close the business, or the business perhaps get liquidated, you will still have the property because it's not part of that particular entity that's now being liquidated. Another example is if you have a large volume of operational employees versus your admin employees, for instance, manufacturing or logistics for transport, and you pay high rates of workers' compensation. It might be not a bad idea to consider to register your admin employees in a different entity, a separate entity, where you then qualify for lower workers' compensation rates. But again, that's something that you will need to sit down with your accountant and discuss, to look at all the costs involved in weighing up the options, what's the benefits and what's the cost involved. But it is something that you need to take a look at. Next on, we're moving on to shareholders, and this is also touching on when you're registering an entity. Obviously, you need to issue shares. There's a share, there will be shareholders. You can and shareholders you can for companies, you can only issue and sell shares. You cannot just give away shares. And a lot of people say, but I'm giving my company to a family member or to my son. He's taking over the company now. He's not the shareholder. There are implications that you need to be aware of. There are tax consequences if you're giving away shares. If you're just giving it away, there's going to be donations tax that's going to be that you're going to have to declare, or because you remember that your shares, there's the value to your shares. Maybe not when you start the entity from scratch, but as you trade and the business goes on, those those shares become more valuable, and there's a monetary amount that needs to be applied to those shares. And it will be, it's not a bad idea then to, when you're perhaps considering in selling your shares or issuing shares, to raise capital or to increase an existing stakeholder share, to remember that share that you have, those shares that you have, there is a value connected to those shares, and you need to do a fair value assessment of what the value of those shares are, and that's where your accountant can be very helpful to assist with that. Also, you need to remember the importance of keeping the company and share register up to date. And again, this is also a requirement when you're registering an entity. You need to keep that up to date. And this is something that we come across a lot, is that that is not being done. There's no company or share register. This is very important. You can imagine if, because SIPC does not keep record of who the shareholders are. Remember, they only keep record of the directors. There's no record keeping of who shareholders are and who the owners of companies are. That is your share certificates and your share company register. Now, I can imagine if there's no record of that and record hasn't been kept, and something happens, say for instance, the business owner passes away and he was the only shareholder and director. Now there's no record of who owns this company. So what the steps to take? So that can have major implications if you don't know who the owner of this company is. So this is very important to keep record of that. Moving on, directors, especially in the change of directors. You need to, if you perhaps change directors, you need to, one of the first things we look at is the entity still owner managed as per the Companies Act, Section 38. Now, owner managed means all directors should be directors, or all shareholders, sorry, should be directors, meaning every shareholder should be part of the management of the company. It doesn't necessarily mean that all your directors should be shareholders, but all your shareholders should be directors. They're part of management. If that's not the case, if you now have an additional shareholder or you have a director that was a shareholder, but that director is not a shareholder anymore for some reason, independent review comes into play, and an independent review, there's a lot of cost involved in that, and you need to take that into consideration when making those decisions. Also, you need to keep in mind that any changes in directors, SIPC needs to be informed. There are certain forms that needs to be filed. Your COR 39 with the relevant documentation needs to be sent to SIPC. If those documentations are not correct, SIPC will reject that application for the registration of the new director. It won't be accepted. You have to start the process again. Again, the same. You can ask your accountant what those documents are, but that will be the minutes, the resolutions, all those type of documents that needs to be filed to SIPC with your COR 39, and you only get a certain amount of time. Normally, inside 9 days, you have to send these documents through to SIPC for them to effect the changes on their side. Also, and we're going to touch this now on the next point before we move on to questions, is changing or updating your tax representative or public officer. So this is very important, and this is a responsibility of the directors. Your accountant cannot be the public officer or your tax representative. It's a statutory requirement for every registered entity. It's also a requirement from SARS that every entity should have a public officer or registered tax representative. We need to make sure that so when you register a company or appoint directors, you need to make sure that you also appoint the public officer or tax representative. And when that person, that director perhaps, who is the tax representative or public officer, perhaps resigns as a director, that person also needs to notify SARS to change that person is no longer the public officer anymore. Because if he only if you do not do that with SARS, if you only update sub-C and you inform them, but you do not inform SARS, then that person will still be noted as the public officer or tax representative of SARS. So you might not even be a director anymore. You're not even part of the company anymore, but you're still a tax representative, and that can have major consequences. If something happens in the company, for instance, they are behind with the taxes, or there's some tax implications with SARS, their audits, they will come to you as the public officer of this entity. So that is very important to make sure that the steps are followed when updating your tax representative. It's very frustrating at the moment with the way that SARS has now changed a bit in the way we're updating those representatives. In the past, you could do it on your Raver 1 form, but recently, if this has not been done in the beginning, if you did not update your public officer representative when you registered your company and when you registered for income tax, then there is no record of that. That means there is no public officer, and then SARS will have no record of that. So your tax practitioner might have your e-filing profile with them, but they won't be able to update that on e-filing anymore. So you will need to go into SARS, or you will need to contact SARS, and you will need to upload all the necessary documents, and this can take time. As we know, SARS works with 21 business days or working days. So it can take a lot of time, and this can prevent that can have certain implications when it comes to your business. For instance, what we see now is if with the public officer is not up to date, one of the first questions when you file an annual income tax return, one of the first questions that comes up is, are the tax representatives or public officers up to date? Now, if you say yes and it's not so, and there's perhaps a tax refund that is due to your company, and SARS picks up that the public officer is not up to date, they will not pay out that refund until the public officer or representative is up to date. So you can imagine the impact on this and the cost involved. If this wasn't done from the beginning in the correct way, there's going to be cost involved, because your accountant will have to now do these things and spend a lot of time. As you can imagine, spending time with SARS, phoning them, it's quite tedious. It takes time. So I think it's unnecessary cost involved in updating those tax representative public officer. It's something that could have been done from the beginning. So if it was done correctly, it can save a lot of time. Shane, can you hear me? Maybe we can see if there's a couple of questions before we move on to the next point. Rick, thank you for your question. Yes, that's very true. But I think you should appoint an accountant when you start an entity anyway. So maybe if you don't have an accountant yet, you should really consider appointing one, and then ask them. Even though they will tell you, listen, no, you should maybe go to a lawyer, or maybe we won't be able to assist. But I think it's always a good idea just to consult them, just to ask them the question, and they will be able to point you in the correct direction.
Yeah, thanks, Cobus. I think, using your lawyer and your accountant together rather than separately is very, very important, because both the lawyers and the accountants have different areas of expertise and different areas of experiences with companies and registering companies. And I understand that many people open up companies through CIPC or buy shelf companies, as Cobus has mentioned, and MOIs are incorrect for that particular company. There's just a whole host of problems. We would love to get through to every single person in this country that goes around willy-nilly opening up companies and trading in them. Very difficult to do so. So hopefully our information sessions will help. So yeah, Rick, thank you for that question.
The next question, Michael, thank you very much. Would any of these packages be able to use or be compatible with IXBL reporting? Anything you would recommend? Sure, Michael. I'm not sure, Monique, are you familiar with, or do you know any packages?
I'm not really familiar, but I think if Jolene is on, I think she is attending. I know that Jolene does the independent reviews, a lot of them she uploads. Jolene, are you able to come in?
Belinda, you've given me the cue that I was looking for. Folks, I've got a solution, and that I'm a DraftWorks distributor, and a lot of the BAN franchisees actually use DraftWorks. So, Monique, would you be happy if I run a poll if anybody is interested in DraftWorks, and we can send them some info? And
yeah, we do use DraftWorks. I'm not sure if any of the accounting packages have.
I'll run a little poll at the end, and if any of you are interested in DraftWorks, we'll send you some info on that. Lovely. Thank you for the opportunity. There's just one more from Michael. Maybe I'll just get that ready. Michael, thank you for this one as well. There we go.
Thank you, Shane. Just Michael, just on the previous question, I'm not sure if that will relate to your accounting package, but definitely to your reporting package, for instance, for your annual financial statements, and that is what Shane mentioned with DraftWorks. It's very relevant. Are you referring to the independent review, I assume?
Yeah, look, on the shared tab, there were various comments there regarding the share register and various other documents that needed to be kept up to date. I have a lot of clients that are small businesses, owner-managed. Their PR score is below 10 generally. So the question is, would those sort of parts of the company that still apply to them? They are registered closed corporations or private companies.
Yes, that will definitely apply, Michael. So every entity or company will need to keep record of their company or share register. As I said, you need to keep record of who your shareholders or the owners are. As I said, SIFSHI does not keep record of that. So yes, it is a legislative requirement, Companies Act requirement, that you keep record of those things. Yeah.
Thank you, Michael, and good to see you on a BAN webinar. And thanks for coming in on the mic. And that's just it was a lovely demonstration, guys. We can do that for some others as well if there's any more Q&A. There's nothing further, just two responses from Belinda and Jolene, which I think I just need to share with you at this point. First of all, Belinda wrote, none of the accounting packages, it is a financial statement end product. So I think that, I think that Belinda's probably researched it and has found that, none of the other systems offer it. And then Jolene has also written, thank you, Jolene, IXBRL is usually linked to your drafting package and not your accounting package. So guys, you need DraftWorks. I'll send you some info. Here we go. Back to you. Thanks, Cobus.
Thanks, Shane. Yeah, just on that DraftWorks is amazing. It's brilliant. I love it. Yeah, so that is for you. The IXBRL is for that is for you when you file your annual return. So there's two options when filing annual return. So I presume that is what Michael was referring to. But thanks, Belinda and Jolene, for your input. Appreciate it. Moving on to the next, applying for finance. This is very important. This is where the importance of management accounts and your latest signed financial statements come into play. When you apply for finance, and this is something that we came across to quite a bit last year in COVID and in lockdown, where businesses couldn't operate at full capacity, and a lot of businesses were forced to apply for finance, and we found that a lot of companies or entities did not have updated management accounts. So this is important and this is not one of the reasons for management accounts. This is the one reason applying for finance is management accounts. There's so much more value in having management accounts, because then you can review your business and all those matters. But applying for finance is very, very important, and also your latest signed financial statements. Banks normally do not accept finance if they do not have the latest updated signed financial statements, and it should also be, it can't be a year old financial statement. It should be the latest available. So that is very important to look at that. Also something that you will need, it will be an accurate cash flow projection and a financial forecast. And this is where your accountant can assist again. And we need to remember that your cash flow is not necessarily the same your profit that you have. There's a difference, and I believe there was a webinar a while back where we talked about cash flow versus profits. So it's not the same. There's a timing difference. For example, you invoice your customer now, but it only pays on terms, say for instance 30 days. So it's not the same, and you need to just keep note of that. You also need to understand your entity's affordability and the future impact of that. Maybe there are different. You need to make sure that you will be able to afford the repayments going forward. That is very important. And also take note that your profit does not include your repayments. There's a difference. So your repayments, say for instance, the installment repayment, the only part that's part of your profit or your loss and your income statement will be the interest portion of that repayment, but the capital portion goes to your balance sheet. So it's only the interest portion that forms part of that forecast and that you're using. So the cash flow projection, you need to make sure that that's correct, and that's where your accountant can assist you in to understand that, to make sure that you're giving the relevant and accurate figures into making that decision should you apply for that particular finance. There's different ways of finance, there's different types of finance, but for instance loans or installment sale agreements or bonds. And it's also not a bad option or is to consider different kinds of finance, not maybe just a bank or a financial institution, but maybe you can approach family or friends or your personal mortgage on your home loan, and that will then be a loan from the shareholder to the entity. So, but again, just something that you, when applying for finance, just sit with your accountant to go through all the relevant options and to see what the affordability will be for your entity. Next one, we will be touching on changing of banking details. This is also something that is important. When you change, and this is not necessarily when your first bank account, this is more in touching here on when you change your banking details, or even if you add an additional bank account. It is important to inform your accountant, obviously, of this, especially if your accountant is responsible for the processing of the transactions, that they need to know that there's an additional or a new bank account. Also very important, and something that we've seen a lot, is this needs to be updated on your SARS e-filing profile. Now, if that profile is with your tax practitioner or your accountant, that person needs to update that bank's banking details with SARS. If that doesn't happen, then SARS won't be able to refund you your VAT refund or income tax refund. What we've also seen what happens quite a lot is SARS will put a bank stopper when they see any changes in bank details that hasn't been updated accordingly. They will put a bank stopper in. Then you would need to send them. You will need to make an appointment, hopefully virtually. You don't have to go into the branch. You can do it virtually, but it's still an appointment. You need to send them all the relevant documentation, bank statement, proof of bank details, IDs, and that can take another 21 business working days for SARS to update and lift that bank stopper. So you can imagine if you were waiting for a large refund, now you have to wait additional 21 days, or even perhaps longer. They sometimes take longer than that, for that refund to get paid out, and you've perhaps wanted to use that money that you made. You included that refund in your forecast, your projection for the month for your cash flow. Now you're not getting that money, so it's something that could have been avoided if it was done correctly in the first place. And then obviously also to remember to update your banking details if it's a new bank account on your customer invoices and statements to ensure that the customer's paying the correct account. And also a good idea is just to send in perhaps a notification out to all customers that there's been a change in banking details. Maybe perhaps you're just adding an additional account for where you keep your VAT payments for VAT or for income tax. It's like a savings account. Also, again, just important to let your accountant know, especially if they're processing all the transactions, if you're perhaps using cloud-based software, you need to link that bank account so that that transaction can be processed timeously. If we're moving on to the next slide, we're looking at your fixed asset register. Again, it's very important to keep this up to date and make sure that it reconciles with your accounts ledger and your annual financial statements. You need to inform your accountant of all changes, especially if your accountant has the fixed asset register with them. If they are keeping it up to date for you, it's part of their working papers or the management accounts that they give you every month. They will not know if there's been any changes, if you perhaps sold something, especially if it's something you disposed of, or it's an asset that you scrapped, or it's something that you sold but it wasn't through the bank. It was a purely cash transaction. Your accountant might not know, and the accountant might keep on depreciating this asset if there's depreciation involved. And obviously, then that is a mistake. That's incorrect. So there could be obviously impacts, and that could influence your provisional tax calculation if depreciation is not correct or inaccurate. And then obviously the impact on the financial statements if your fixed asset register is not accurate, if there's assets on your fixed asset register you do not have anymore, then that means that your assets can be overstated on your balance sheet, and that obviously is incorrect. And in terms of reporting for an accounting officer or a CC, or the compilation report for the annual financial statement for a company, that can adverse effect where they will need to qualify that report because of assets that's not correct, and that report can be misleading. As we know, for companies, your assets need to exceed your liabilities, and this could obviously have a big impact if your fixed asset register is incorrect and not kept up to date. We're moving on to the next one. We're looking at petty cash and record keeping of transactions, supporting documents. We can start with petty cash first. Petty cash, it's very important to, even if you just keep an Excel sheet of transactions, because truly you have an audit trail. Because if a cash transaction happens and you didn't keep record of it, and you, 2-3 weeks down the line you can't remember exactly what it was, how are you going to report for that? Because there's no audit trail. Like for instance, a bank transaction, we have a bank statement where you can go back to. It's also very important to keep a record of the invoices or the slips for those transactions, and also to keep cash counts, regular cash counts of your petty cash, and to reconcile to what your petty cash reconciliation is toward, and versus your cash count. And especially this is also very important for where you have employees working with the cash, to make sure that this is done on a regular basis, preferably on a daily basis, and then the two people will sign off on these sheets where the cash count has been performed versus the transactions, to make sure it's correct. And employees you can imagine if there's now a difference, who's going to pay for that? If there's a shortage on your cash, who's going to pay for that? If there's no slips and invoices, no records were kept, especially when it comes to like entertainment, or you bought something at the local hardware store for just a small transaction, but that all counts up and adds up to the end of the day. So it's important to keep record of that. Also, we're gonna this is gonna go into the next slide with the VAT and VAT verifications. You need to make sure that those invoices that you have, that it's a valid invoice, and that obviously not all entities are registered for VAT, but you still need to make sure that it's a valid invoice if it comes to, even if it's for income tax. So I'm going to move over to the next slide for VAT and VAT verifications. First off, it's important that you inform your accountant when your turnover reaches 1 million rand, so that the entity can be registered on time. If this didn't happen and you have continued trading and you exceed the 1 million rand, SARS can deem output VAT on the taxable revenue that you've made, and they can raise interest and penalties. And now it's going to have a serious knock on your cash flow. For example, you did not, you now have to declare 15% output VAT on those transactions, on the revenue, but you did not recover this from your customers because you did not charge them the VAT separately or on top of the sale. So now you have a shortfall of that 15% that you don't recover, and then you add on the penalties and interest that's added on. So it is very, very important to let your accountant know when you reach the 1 million, or when you're nearing the 1 million. You perhaps know that it's going to happen in the next month or so that the accountant can be aware, especially where your accountant's not necessarily responsible for the day-to-day transactions of your business. Also, again, and if you're not sure, you can ask your accountant, but what is a valid tax invoice for VAT, to make sure that you have the tax invoice is valid. Just quickly, SARS will look at the address. So the address, and that is for, you need to make sure that your details are correct on your own custom invoice, but also that your details are correct on the supplier invoice that you're getting from your supplier. So those details need to be correct. Addresses, it needs to be exactly the addresses what SARS has on their side, needs to be the same. Otherwise, they will not accept the invoice. The VAT numbers for the customer and the supplier needs to be the same. And there's more stuff that SARS will look at, but need to make sure that that is correct. With VAT verifications, if you imagine you're sending invoice to SARS and they reject that invoice, that means you cannot claim that input claim that you did. They will reject it. They will mark it as non-compliance because you fraudulently claimed for a invoice that is not valid. And then obviously there's going to be a shortfall because you're not getting that input. You're going to have to pay more, and then obviously they can add interest and penalties. So, and also when you do exports or imports, it's very important to keep record of your customs documentation, your SAD 500s, and the relevant documentation of customs. Make sure that if you're using a customs agent to do this on your behalf, make sure that they not only send you the tax invoice, but they also send you the custom documentation that goes with this, because this is something that you need to provide to SARS if they select you for a audit verification or a VAT verification. I've seen in the past, especially when there's import duties and import VAT claimed, they normally will ask for all this documentation before they give the refund. And you also need to make sure that the correct VAT treatment of your taxable supplies and input claims is correct. Is it zero rated? Is it input VAT standard rate 15%, or is it exempt? You need to make sure. And again, not sure. You need to ask your accountant to make sure that it's correct, so you don't have any issues going forward where you've perhaps applied the incorrect VAT treatment of the transaction. Before we're going to, I'm just going to touch on the next one, and then we can move. Oh, I've seen you running out of time. Maybe I'll just go to this one quickly. E-filing profiles. This is very important, and this is causing a lot of frustrations where the e-filing profile is not set up correctly. Some clients choose to have their tax profile on their profile because they would still like to have access. So you should then rather not share your login details with your accountant or tax practitioner, but rather create a user for them to invite them so that they can be linked. SARS will not assist, and this is something that came in November last year, or October, November last year. They will not assist the tax practitioner or accountant if they cannot verify the link between that practitioner and the client. They will not assist you. You will not be able to be, so that you will have to phone SARS yourself if that's a problem. So rather just contact ask your accountant to show you how to create a user, just to invite them if you would like to keep access to your tax type e-filing profiles. Also, when that happens, just make sure that if there's important notification from SARS, it doesn't always mean that the tax practitioner will then get those notifications. If there's shared access, to make sure that you provide them with those notifications or letters from SARS, especially for instance VAT verifications or EMP 501 or EMP 201 verifications, so that they get this timelessly, so that they can submit the documents inside 21 working days that's been allowed. Otherwise, if you miss that, that again can be seen as non-compliant, and penalties can be issued. I think, Shane, maybe we just got a couple more to go through quickly, and then we can maybe just do the questions at the end. We're moving on. The next is your directors or owners as personal expenses. Also very important to make sure that this is treated correctly. We're seeing a lot of expenses paid by the company on behalf of directors or owners. This either gets sometimes allocated straight to the income statement as an expense, which is not valid, or it goes to the loan account of the directors or the shareholder. But there's not always a good record keeping of what the balance of that loan is, and that might sometimes lead to a debit loan, which can obviously have influences. If you have a debit loan, then you owe the company money. The company doesn't owe you money. You will have to then there's other issues that come along. Is the company solvent? Is it because you're now owing money to the company, you need to make sure that is treated correctly. We're also looking at purchasing of assets for personal use or assets that do not generate income. So, for instance, a motor vehicle that the directors or the shareholders have not purchased, but that vehicle they use more for private use than actually for the business. So then there is fringe benefits that get triggered for that. So you have to declare a fringe benefit. So fringe benefit tax needs to be added to your salary. Then obviously the salary that you get out at the end of the month is less than you usually got because of the pay as you earn. That's now more. There's also deemed output VAT that needs to be cleared. So you need to make sure if you purchase an asset, if it's going to be used more for personal use than for company use, then rather consider purchasing that asset not in the name of the company, but in your personal name. Also, when purchasing assets, make sure that you can claim the input VAT. For instance, a passenger vehicle, you cannot claim the input VAT, so make sure that it's correct. Again, directors using company-owned assets for private use, as mentioned with the vehicles. There could be other examples as well. Using property themselves, living in the property that is that belongs to the company. There is fringe benefit tax that needs to be declared on that. So you need to consult your accountant just to make sure that that's treated accordingly, so that there's no issues going forward in terms of penalties and interest or under declaration of pay as you earn. Also, just to touch again on the director's loan. It's advisable that you regularly review the transactions on your loan account, and then it gets signed off and approved, and make sure that it's correct. And also, just touching on that, if you can touch on that again, what we've seen as well is sometimes there's directors' expenses being paid by a company, and then there's VAT being claimed on it. So they will still move the expense, the excluding amount, to the loan account, but they're claiming the VAT. Now that expense is not a deductible expense, it's not a company expense, so you cannot claim the input VAT on that. So this is something that you should always just be aware of when a company is paying for expenses of directors or owners. Moving on quickly to declaring of dividends. So when you declare dividends, obviously again, please inform your accountant that you want to declare a dividend, so that they can assist you with assessing if the entity is solvent and liquid. You cannot declare a dividend if the entity isn't solvent and liquid. Your current liabilities or your current assets exceed your current liabilities, and your assets exceed your liabilities. And then obviously if there's debit loan, we also need to take that into consideration, but to make sure that the company is solvent and liquid before you can declare a dividend, and then also to file and pay the relevant dividend returns simultaneously. If you declare a dividend now, but you're only informing your accountant a couple of months later, then obviously you've missed because that dividend is to be declared in the month, or in the month it's been declared. You need to file the return, and you pay it in 30 days after that, so that's in the next month. Now you can imagine if a dividend was declared and paid not on time, and you're now in a new financial year, that can cause extra penalties or interest that can be incurred due to the dividend not being declared on time. So just need to make sure of that. We can move on to appointing a finance staff. Also, again, this is perhaps a good idea when you're looking to appoint, perhaps, for instance, a bookkeeper or a credit clerk, just to maybe ask your accountant to sit with you, especially in the interview process, to go with you, for the interview, to make sure that that person has proper skill set and will fit in with the company, but obviously will be able to do the work. There's no use appointing someone and they do not have the proper skill set, and they're making a lot of mistakes, and your accountant has to come afterwards and fix all the errors, and they're just extra costs that your accountant is going to charge you for something that should have been done corrected in the first place correctly. So appointing of a finance staff is a good idea, to just to ask your accountant to sit with you in that, to participate in that process. There's 2 more slides to go. Payroll employees, this is again very, very important, especially when your accountant does your payroll. You need to inform them of changes to staff. If there's any changes, resignations or additions, new employees or whatever, or maybe retrenchments, to inform your accountant, because they need to update that accordingly, to make sure that it's treated correctly. And obviously it takes time to do payroll. Obviously inform them in advance so that they have enough time to do that, especially if there's a deadline of, say for instance, you pay out your salaries on the 25th, obviously that the payroll needs to be done by then, and your relevant returns needs to be filed and submitted by this 7th of the next month, to make sure that it's all correct, so that there's no issues with that. Also, increases or bonuses declared, there is pay as you earn consequences, UIF consequences in that, so you need to make sure that the accountant is aware of any of those changes or bonuses, so that they can process it accordingly. Also, another thing that's very important, especially now with the EMP 501 filing season that we've had last month, every employee needs to have an income tax reference number. Whether if they don't have one, they need to be registered. So that can be done in e-filing. Your tax practitioner or your accountant can assist you with that, but need to know that it's an employer's responsibility to make sure that the employees are registered for income tax. Cannot file the EAP 501 if there's no income tax reference numbers on the EAP 5. So that's very important to make sure that is done. Also, if you perhaps employ foreign employees, to make sure that they are legal and that they have the relevant documentation, and that should also be sent to your accountant. Again, if you perhaps get a payroll order from SARS, that is stuff that they will look at, and there can be major consequences if you employed somebody that's not legal or doesn't have the correct or the relevant documentations or visas or work permits to work for you. Make sure that is correct. Then also the benefits paid to staff. We need to consider if there's fringe benefits involved, in terms of cell phone allowances or just paying their cell phone. They're making use of company assets to, like a motor vehicle, they can drive home with the vehicle because they use the vehicle. Driving from home to work, SARS does not see that as a business related, so that is a private expense. So there's a fringe benefit that needs to be declared on that. That will influence the net pay of the employee, and there's also the deemed output that needs to be taken into consideration. And the last thing, just to touch on staff loans and advances. Again, you need to inform your accountant as we want to put this on through payroll, so that it's treated accordingly and correctly. Just the last thing I would like to touch on is when there's more than one accountant is involved. That sometimes happens that you have an accountant that's designated to or assigned to for your VAT. You have an accountant for your income tax, and then maybe a different accountant that does your annual financial statements. It's important that all of them are informed of changes, and that they have access to the different reports needed. For instance, if you have an accountant that does your income tax, and you have somebody else that does your bookkeeping or your record keeping for transactions, that they communicate so that they can make sure, for instance, when they do your provisional tax calculation, that they have got the correct information and not to do, so that they not make mistakes, for instance, under declaring your provisional tax. So that's very important just to be aware when you have more than one accountant involved, so that they should always be informed and up to date of what's going on. Even if you just send an email to them, just to notify them of any changes. Michael had a question in regards to benefits paid to staff. How would I treat it when the owner gives his workers money to cover taxi fares to and from work, around 100 Rand per week, separate to their salary? Would this be a fringe benefit? They are earning below the tax threshold. It's normal remuneration that unfortunately have to declare, but that will probably not make a difference in their taxable income. It will probably still be below the tax threshold, but it's something that you still need to declare on their payslips. It should be declared, and obviously this will influence the UIF and if there's SDL involved for the company contribution.
Yes. So it's not a fringe benefit, it's normal remuneration.
Thank you, Shane. Yeah, look, the question's simple. It covered e-filing and clients e-filing. Some clients wanting to e-file, keep it on their own profile. What is better, transferring the profile to mine, where I have a whole lot of my businesses already registered, or becoming a user on my client's e-filing profile? Is there any sort of preferred way, or does it not make any difference?
Thanks, Michael. Obviously, prefer to have it on your own profile, because then you have access and then you get all the notifications when there's notifications loaded. But I do know that some clients do prefer that because if it's on your profile, then they don't have any access. They can't see what's going on. So some clients they like to access their profiles to see what's on the tax types, what's going on. So then it will be better to create a user, so that you can also then access those profiles. But then obviously, what I found in the past that the notifications or the letters sent by SARS doesn't always get emailed, or you don't get the notification as a user. Maybe it's just the user right that needs to be updated or corrected, but that's obviously just something important to make note of, is to just to make sure that you get those notifications and letters from SARS.
Thank you.
Monique, I'm not sure, do you have anything that you would like to add on that?
Nothing to add. I think that's perfectly, sums it up.
If you go to the BAN website, just go to www.ban.co.za and then look for events. If you click on events, that's where you will find there's a whole lot of other, if you just go to complimentary business webinars, you'll be able to see there's awesome information there for you. I have a client who has a volunteer coming to work, I presume to work here is missing, to work here from Germany. The sponsor will pay them from Germany. What would be the tax implications in terms of SARS? There we go. Thanks for that, Ansheen.
All right, Ansheen, I think we need a little bit more facts than that. You mentioned that the German company will be paying the volunteer that's working in South Africa. I presume from that the South African company is not paying the volunteer at all. So there would be no tax implication. It's only when a South African-based resident company is employing the foreign worker and paying the foreign worker will there be a tax implication in South Africa. In this case, it would seem that that's not the situation. Unless I've got your question a little bit mixed up, I don't know if I've answered it or if you meant something different. But please, yes, just, maybe jump on the mic or on the chat box.
All right, that's fantastic. You've answered it. Thank you. Thanks, Ansheen.
Yeah.
Cobus, thank you very much. Thanks, Monique. Thanks, everybody, for participating, for tuning in. Look forward to hosting for you all again, and take care.
Thank you so much for your hosting. Great stuff. Thanks very much, and thanks very much, Shane, and for Cobus's great presentation. Thank you.
Thank you. Goodbye.
There, everybody.